Nobody wants to see a falling market, much less during retirement or right at retirement. I had a client who retired in January of 2022, and the financial plan was there. Everything looked great. But since then, the market has literally just fallen and then rebounded. And here we are again, looking at the market saying, what in the world is happening? Now, it's hard to, remember 2021 because 2021 and even previously, the market just continued to climb and continued to climb. I mean, you can look at this chart right here, and I'll show you exactly what I'm talking about. Because since 2008, really all we've done is just pretty much have a bull market where the market is steadily going up every single year. Now, the risk is here, though, is that when you retire and you say, hey, well, you know what? I'm going to take my money at the top of the market. I'm retiring. I'm at the top of my game. Everything is great. But then the market falls apart and you forget that, well, hey, the market averages, 9.91% a year. And this is for the past 30 years, including dividends. So that's reinvesting the dividends. And so that's what your averages are on the market. But when you're having years that you're getting 20+%, you forget about that average. And then you say, well, why is my money down this year 10%? Well, guess what? The market has a funny way of humbling people and saying, hey, I'm going to give you 9.91. That's what I've done for 30 years. That's what we're sticking with. And so looking here, though, if you're getting ready to retire, you're right there in retirement. This is a tricky spot to be in because if you went out on top or you're going to go out here soon, you've watched your money steadily fall and maybe it's recovered some in 2023, but this chart's a few days old. And this chart right here shows you that on 929 is where the market is, but actually the market's pulled back quite a bit from there as you're watching this video, if you're watching it here in mid to late October. And so what we've got to figure out is what the heck do you do? If you're in this spot right this second, what are you going to do with your money? Because if we're looking right here, we can start to say, okay, well, where are we going to put our money? There's lots of opportunity right this second on where to put the money, how to invest. Do you just jump out of the market? Do you not? Well, if you're just riding the S&P 500, your annualized return is 9.92%. Your small caps are down 8 to 8.76, long-term bonds at 5.58, gold 4.68. I want to show you gold, though, for a second, because we're not massive fans of gold and precious metals around here at Jazz, but I'll show you why. Because if we're looking here at gold, that's that kind of almost gold orange line. And right here, what ends up happening is if you don't time gold properly, yes, your long term is there, but in the short term, it's not. So people who go to a safe haven just for gold, if they get in right here, you're actually at one of the highs for where the actual gold price has been. So be very careful on just trying to jump into something that you think is a safe haven if you're buying at a really high price. That's the opposite of what you want to do, though, down in here in your heart, it may tell you, well, man, I feel like this is what I should do. Be careful just jumping into something because you think now is the time. Short-term bonds, 3.93, U.S. inflation, 2.68. That's been the average there over 30 years. And so you've got this risk. I talk about, where you're putting your money, what are you going to do? Well, if you just jump out of the market, this could actually ruin your entire retirement. All of your money gone. I want to show you this exactly because right here, the risk of running away. If you bought and hold the S&P 500, this is showing a 9.71% annualized return on this. But then you move to cash at the bottom of 2008, the financial crisis, for 1 year. For 1 year, you move over and you say, I'm going to wait 1 year. Well, if you just wait the 1 year, you're going to get a 6.77% annualized return. Now, you're probably thinking, hey, that's not bad. I'm okay with 6.77%. That is literally trying to say, perfect. I know that the market's going to go up nothing but from here. The problem we've seen consistently is people aren't doing that. Instead, you say, you know what? I don't know when I'm going to get in. The market's up a little bit, but I'm afraid it's going to pull back. When do I do this? You start playing these games. You start to really try to time the market. And again, as I said, it has a funny way of humbling you. So if you just went right here, the global financial crisis, you went out and you held, you're going to have a 0.86 annualized return. I hate to say it, but I talked to somebody in 2017 who had done just this, and they literally missed out on a skyrocket of rebound from the market. So you've got to understand what to do. So how are you going to invest the money? That's what we've got to figure out. Well, you could say, well, I'm going to put it in the S&P 500 index and let it ride because the S&P 500 has obviously done the best out of everything that Eric has said. Well, you could do that. But if we're looking at this chart, here's what we have to figure out. Because if you are near retirement or going into or in retirement, you've got to really figure, what exactly should I be buying and when? When's the best time to buy anything here? Well, this is a chart showing asset class performance, basically saying, okay, well, if I put it in the Russell 1000, the S&P 500, the Russell 1000 value, 60% S&P, 40% the bonds, you could start to look and say, okay, what in the world do I do? Because this chart is showing me that every single year, everything is different. And that is truly how it works. And this is why diversification is probably the most important thing that you could ever do in your life when it comes to your money, at least, when it comes to your finances, when you're going into the retirement years. Diversify everything. Because if you're just riding the S&P 500 and you retire and the market takes a large fall, you've got to pull from that money in your retirement years. So you've got to figure out where you should be putting it. Right this second, money market funds, high yield savings accounts are paying 4 to 5.5%, depending on where you're at. That's something safe right this second for really short-term money. We've been working with clients that are near the retirement, going into retirement, talking about just this strategy right this second. So that's just the short-term money. You've got bonds. Bonds, if you were in bonds in 2022, you took a beating. But guess what? Bonds are going to have their heyday because eventually the Fed is going to lower rates. And when Fed lowers their rates, that means that the bonds that are out there are going to be more in demand. People are going to want them. They call it selling for a premium. They're going to sell for more than what you paid for them. So that's what you've got to start to structure in your portfolio. Don't just throw it in the S&P 500 or one specific index because that's going to come out and bite you in the end. And also, it's hard to watch those big ups and downs knowing that, hey, I don't have a little bucket to pull from. I've only got one bucket. So make sure you're diversifying, you're strategizing on this. We can help with something like that. Check us out, jazzwealth.com. Thanks for watching. If you want to learn more about Jazz Wealth and how we can help as fiduciary advisors, go to jazzwealth.com. If you want more educational content, be sure to check out our videos here.